Okay, welcome everyone to Trading Coach's Playbook. This is Brandon Waddell with you. And we'll go ahead and kick this off as we usually do with a quick reminder that we are not broker dealers or investment advisors. So we're going to be looking at the markets possibly today from an educational standpoint, which means I'm not telling you to buy, sell, or hold anything or give any personalized recommendations about the markets. While markets do involve the risk of loss, that is always a situation. We can never eliminate that risk. We just try to minimize and manage it. We're also not subject to trading restrictions, so we can have positions in securities or initiate them at any time. So welcome everyone. Putting a couple things on here, and let's see, is the chat. There we go. Now I can see the chat. Changed a couple of settings here. We're good to go. All right, perfect. We keep pretty busy here, obviously, at Wealth Builders HQ. A lot of things going on. As far as the free online workshops, you can join us every Monday and Friday at noon. And we are basically doling out some free information about the markets and about trading itself and how we do it in different manners. Got kind of a rotation of different instructors there to kind of pick and choose from. I focus primarily on futures and options, and even options on futures. And I'm doing a couple of free workshops coming up. As you can see, I've got Futures Trading Simplified coming up next week. If you wish to join me, you can go ahead and find that online, wealthbuildershq.com. And one of the things I'm going to be talking about today is a different way of trading futures. And there we go. We got the link as well. So thank you, Andrew, for posting the link for us. But yeah, the Futures Trading Simplified, you can click on that link. Let's see, it should have. There it goes. I clicked it twice. Anyway, I'll talk about different ways of trading futures and options on futures. Like I said, and you can reserve yourself for one of those classes. There's quite a few to choose from, either in the evening or in the afternoon, whatever works best for you. So I'm trying to keep it pretty open for you. Anyway, actually, before I go any further, want to make sure I'm logged in as well because I want to share a couple things with you. Like I said, I trade futures in a lot of different ways. And one of the ways that I've discovered of trading futures that works really, really well for me is spread trading. And you may not be aware of spread trading or even what spread trading is, but I'm going to explain a little bit of it today and just let you know, if you're interested. I did this workshop a while back called the Spread Spectrum, and it explained a little bit more about it, but I'm going to kind of go over some of that stuff with you as well right now. But I have a program called Wealth with Spreads, and it is designed, again, for building wealth, not necessarily income, because most of the trades are a little bit longer term. They're swing trades, meaning you're not in and out in the same day. And the way the program works, there's actually several different pieces. And what I want to stress about this type of trading is high probability. It may not be as high dollar-wise or income-wise as directional trading, but it can be much higher probability. And I've been, like I said, I've been doing this for quite a while. And I kind of track some of the trades I've been doing. And there's the different programs I have. I'm mentioning again the Wealth with Spreads program. And I actually started this, I think, in 2021 with Wealth Builders HQ. Yeah, it was in January 2021. I started doing those types of trades, and I track every single thing that I do. I put out a lot of different trade ideas. Unfortunately, not all of them come into entry, but you can see we have a lot more winners than losers for the most part. Interesting thing here, in April of 2021, we actually had more losers than winners, but because my average loss was relatively small compared to my win, I was actually making a profit that month, even with a 47% win rate. So I want to stress that while there is possibility of loss, the way that spread trading of futures works, you have a much higher probability of win. And when you lose, you have a relatively smaller loss than you would if you picked a directional trade in futures trading. I'll explain what it is. And I maintained this consistency for years. That's 2021, about 71% win rate. 22 was up to almost 76% win rate. Again, didn't always have a lot of wins. Sometimes we had, this one we didn't have any negative percentages. It was as high as 93% win rate, as low as 63. 2023 dipped a little bit, but again, still doing well. Did have a couple negative months. So it is possible to lose money. You can see in February and also in April, not ashamed to show, even in December, I had 3 losing months, but overall net for the year, I was positive. 24 picked it up a little bit better. Even though the win rate dropped, the size of the winners were bigger. And I didn't have the negative months. I had positive months. Even when I had a poor month, it was still positive. You can see this was a 37% win rate, really bad that month, but it was also on vacation. We didn't have that many trades. And basically, yeah, it was still positive. And now for 2025, back on track, doing much better. You can see the average total per month has gone up quite a bit. From last year, it was about 12,000, and we pretty much almost doubled that this year, even though the win rate is gotten better as well. And you can see I'm not getting negative months. Look at this. This is interesting as well. My win rate with all the trades going in, because we had 10 losers, seven no entry, only 12 winners, 48% win rate, and still positive again for the month because the winners are a lot larger. So, what the heck is this spread trading all about? Well, it's not like options. You're not trading options. Okay. When people talk about spreads, typically they think of an option spread where they're buying an option, selling an option. And that's not what we're doing here. What a spread is simply trading a long futures contract and a short futures contract that's related. They have to be related. They could be the same underlying security, or they could be different types of securities that are related, like gold and silver, NASDAQ versus Russell 2000. So you're simply buying one and selling the other. And yes, you are going to have a profit and a loss. One of those positions is going to lose, one will win. As an example, let me go out to a live chart. It's always more fun to work with live charts, and it was right there. So I was setting up a couple spread ideas for now, but I'll go to this chart currently. And I'm on copper. That's fine. We can use December copper. We typically look at bigger time frames. So I'll go out to a daily chart and hard right edge here. There we are. Current contract. Now, if I were to go out to, say, the CME group and look at markets, there we go. We got copper. If we look at the quotes, you'll see that there are many different options available for what we could trade. We could trade the October contract, November, December, January, February, March of next year, all the way out. It goes even further. If I load all, I can go to 2030 and trade the December contracts. I'd be the only person trading them because there's no volume there, but it is tradable. As a matter of fact, there's somebody that traded 3 contracts for March 2027. Look at that. 42 contracts for December of next year has already been traded. So what happens is the contract with the most volume, and I go all the way back here and we take a look and we see that the December contract, even though there's still an October and November contract available, the most volume is on the December contract. That is called the front month or near month. That will typically move furthest and fastest in whichever direction the futures are moving. So in today's market, the copper is moving down. We see all these negative numbers here for the change today. And you'll see that that's moved down by 0.47%, almost 0.5%. You go down a little bit and you see that we moved only 0.43%. February, for some reason, actually moved further. Then we go down to March and that moved only 0.45%. We have a little bit of a jump here where there was an April big move as well. But for the most part, this one with the most volume will typically move further and fastest. The rest of the months are called the back months or far months or forward months. And those are tradable, as you can see. I mean, for instance, we had 4,400 contracts traded for March, but they don't move at the same pace. Now, this is just intraday. You think about this over long periods of time. So let's take a look. Whoops, again, copper. I'm going to go to a line chart because it's easier to see this way. So here's December copper. Okay, it says HGZ25, says December 2025. And I'm going to add in on top of that HGH 2026. Okay, and I think that was, whoops, wrong page. Is that the other one with the volume? Yeah, March 2026. That had the 4,400 contracts traded. So now I'm comparing the two. And unfortunately, they're pretty similar to each other today. So we're not seeing much of a difference. Might have to choose a different contract in longer term, perhaps. There we go. Although maybe if I do this, yeah, they're still pretty close. But sometimes, there we go. Let's go short term. No, it's not working with copper because they're moving too similar to each other. So let's try, actually, I'll do this instead. Let's try the other one that had a lot of volume. That was the 2026 December contract versus December 2025. Let's see if that makes a difference. A little bit more. There we go. So we can go back to, let's see, the beginning of September. And that's probably good there. And what you see is they mostly move together. Okay, now if you're confused as to which is which, right now I have in blue is 2025. And that pink or magenta or whatever you want to call it, I'll just call it pink. And what happened there? That's the December 2026 contract. So what happens is you can see they don't always move together. So let's imagine that we buy the blue one. So we go long and we profit from upward movement, obviously. But at the same time, we short or just simply sell futures. We don't really short, but we sell that future. What would happen? If you had done both of those on a Friday, September 5th, right there, when they moved up into this position, let's say right here is where we're ending our trade, you would have made a profit of about 12%, 12 and a quarter percent on the long. At the same time, you would have lost 11 and a quarter percent on the short. So net, you would have made 1% return. That's what a spread is. A spread is simply the difference between the prices of two related contracts. They could be the same underlying security. In this case, I'm using copper and copper, or they could be two related securities. You know, another example I could use, it probably works a little bit better actually, would be ZCZ 2025. That is corn 2025. And I'll use corn March 2026. And again, let's just take the beginning of October here. There we go. For the most part, they've been moving close together, but not exact. And again, you could see that if you had bought, in this case, the pink is March corn, which we would be selling. And the blue is December corn. And we go long. So what happened? We would have made 1.74% on the long. We would have lost 1.25% on the short. So net, we would have made 0.25%. That's what a spread trade is. You're trying to profit not from the overall direction. And in this case, you can see that it also made a little profit. They came back together. So you can either profit from them separating, like we're seeing here, or if they are separated right now, they will eventually come back together. For example, here, they were separated. If we were seeing at this point, let me zoom in a little more. Make it a little bit more exaggerated. There we go. Right here, you can see that they're separated, right? So what can we do? If they're too far apart, right at this point, instead of buying the December corn, we would sell that one. Because it's overbought. And then the pink line, we would buy. And what happened? We would have lost on the long, but we gained more on the short because they ended up coming back together. Get them back there. There we go. You can see they came back together right there. So the short would have made more money than the long would have been losing, and you would have had a net profit for the position. The nice thing about this is you're what's called delta neutral. That means that it doesn't matter if the markets go up or the markets crash. You're simply trading the price difference between two related securities, either getting wider or getting narrower. So the nice thing about that is you actually have higher probabilities, because when you do a directional trade, let's say you're just bullish on corn, You would go out and you would buy the front month contract with the most volume, and you would hope it goes up so that way you could sell the contract for a profit. But what if it went sideways? What if it goes down? You lose, right? However, in a spread trade, it doesn't matter which direction the overall market moves. What matters is simply the relationship between the two. And there's better ways of charting this than what I'm showing you right now, by the way. I'm going to go into that as well. And we could do this, like I said, with gold and silver. So let's say we look at GCZ 2025, that's gold, December 2025. And we'll do that against silver 2025. There we go. Get rid of that indicator. And here we are right now. Let's say from the beginning of October. There it is. Beginning of October, zeroed out right here. Yeah, October 1st. What happened? Gold started going up, silver went down a bit, and they separated. The spread got wide. When it got too wide, they came back together. They actually overlapped and then came back together again. There are opportunities there. Again, doesn't matter if gold or silver are going up altogether. No, it just matters with the relationship between the two. Or here's another one you might be interested in. NQZ 2025. That's the NASDAQ 2025 versus the Russell. They're both equity indexes, so they will move similar to each other. Again, from October 1st, the Russell was showing more strength, and especially recently, right here, you see there's a lot more strength in the Russell than there was in the NASDAQ. However, if you saw they were too far apart, you could have sold the NASDAQ, I'm sorry, sold the Russell, bought the NASDAQ, and you actually made a little bit of profit on both. Not much on the NASDAQ, but mostly on the short on the Russell. That's all spread is. A spread is trying to trade that white space between the two related securities. And it's a very high probability opportunity. It could sometimes be done as a single transaction. Sometimes you have to do it as two separate transactions. It depends on the brokerage you use. Typically, I've been using a couple different brokers. TradeStation has TradeStation Futures Plus, which allows you to place those trades. You got RJO O'Brien. You've got Thinkorswim allows some spreads, but there's certain reasons why you would do spreads versus directional trades, and I'll mention that in a few moments. So again, you're trying to trade the relationship between two securities, whether they're getting further apart or whether they're getting closer together. Are they in a normal relationship? Are they in a different, strange relationship? You know, when it comes to the individual securities, for instance, copper, when I looked at the quotes here, we have kind of a weird market going on. Let's see, last price. You can see that the one with the highest volume, that's the front month right there, we're at 497.55. Notice as we go down the list here, going further out in time, what's happening with the value of that future. Exception though, right here. But for the most part, it's getting more and more expensive, isn't it? Because you got more time left. That is a normal situation for a market. Oops, wrong one. Okay, when you see contracts, they should be more expensive because they have more time left, and the sellers want to get paid for the risk they're taking when there's a lot of time left until expiration because prices could move. Okay, so with contracts having more time left, being more expensive, that's what we call contango. I did not make that up. That's contango, and that's a normal situation or normal market. Because markets, as you go further out in time, should become more expensive. That's not always the case. Sometimes we have what is called backwardation. So contracts with less time to expire, if they are more expensive, that's unusual. And again, that's called backwardation. and it usually will try to revert back to the contango. It may take time though. It may take weeks, months. It could take a while, sometimes even years. And let's see, I'm not sure if it still is, but crude oil was in contango, or sorry, backwardation for a while. So let's take a look at crude oil. Go to CL futures. There we are. Quotes. And the front month, as you can see, we still have November that hasn't expired yet, but there's only 53,000 contracts. So we ignore that one. And we're going to trade December as the front month. And as we go back, notice January is a little cheaper. Then it starts getting more expensive. So it has gone back to contango for the most part. These are more expensive as you go further back. But every once in a while, you'll see that backwardation and then it flips back to contango. That's your chance to take a trade, because if the further out contracts are cheaper, you might want to buy them. The front month, you'd want to sell. And when they switch back, you could potentially profit. So it takes time. I'm not trying to teach you how to do all this right now. I'm just giving you a little exposure to this type of market and show you what's available with the futures markets. If you want to learn more, by all means, join me with the Wealth with Spreads program. Basically, it's got a lot of pieces to it. I mentioned that there's some trade ideas that we put out, but first, there's a bunch of educational videos, and it's on demand. You can watch these videos as many times as you want. It teaches you exactly what it is that I'm talking about here, spread trading. I actually have 2 videos on it. And basically, there's documentation that goes along with it that supports all of the coursework that's in there so you can learn spread trading. Well, learning it's one thing, but being actually able to use it is another. Well, that's why I also produce a video every Saturday. As you can see, I put one out last week for Sunday's spreads, because the market opens on Sunday for futures. So I put out a video and a PDF that accompanies it with all the slides and the trade ideas. And I actually have trade tracking as well and a worksheet that goes along with it. And you can see how we've been doing in the past as well. But basically, for instance, let me show you. If I go to there's September, that was last month. Every week, as I said, I put out a bunch of trade ideas. So yeah, we'll go with this one right here. Not all of them are winners. Some of them lose, obviously, but this was nat gas as a spread. We were trading the June versus July 2026 nat gas, selling the June, buying the July. And I talk about where to enter, how much risk we're taking, very limited risk, how much margin we're using, and what happened with the position. In this case, it lost. Actually had a couple losers there, a couple winners. And again, tracking everything. Entry was 9/12, exit was October 2nd. Unfortunately, this one was in and out within a day. This one took about 2 weeks to win. 9/1 to 9/11, that took about 10 days for the win. But again, these are designed more for swing trading opportunities. And what I'm going to get to in a moment is they could be relatively inexpensive. That's another neat thing about these spreads. Now, before I get to the margin, actually, I might as well go to the margin since I mentioned it. For instance, when it comes to margin, I need to go to a different area here to get the margin information. And this is on the CME website. It's a free tool that they provide. So let's say you want to go out and you want to trade the NASDAQ futures overnight. Now, if you want to trade the full-size NASDAQ, oops. That's not what I want to do. Bear with me. NQ. There we go. Tab. So you want to trade the NASDAQ futures. You're bullish on it. Okay. Well, you would go out and buy the NASDAQ futures. There we go. Let's say we're doing the front month, which is December 2025, and we're going to go long. Now, one futures contract, you have to put up a margin deposit to be able to trade that future. In the case of the NASDAQ, it is $33,605 to trade. Kind of expensive, isn't it? Now, what could you do to reduce that cost? Well, obviously, you could trade the micro NASDAQ. That's available as well. So let's see how much that would cost you. I just took a picture of the other one just to save it for now. MNQ. And this is nice that we actually have those micro futures available. There it is, MNQ 1225, long and margin. That one is $3,360. Okay, not bad. Remember, it was $33,000 for the full size contract. Now it's only $3,300 for the micro. Well, what if we did a spread on the full size contract? Again, if we were bullish on the NASDAQ, we could either buy the NASDAQ, buy the micro NASDAQ, or we could do a bull spread by buying the front month and selling the back month at the same time. So we're going to buy the front month, December, and at the same time, we're going to sell March 2026. And the margin on that is going to be less than doing the micro. Initial risk margin is $358. Isn't that incredible? So for less than $400, you could actually trade the full-size NASDAQ overnight as a spread. Now, because the margin is greatly reduced, the risk is also greatly reduced, but the reward is also greatly reduced. Now, percentage-wise, you might actually make more than if you did a directional trade by buying or selling the NASDAQ, but you won't make as much, nearly as much dollar-wise. But that's okay. This is actually not a bad idea if you're looking to do some futures trading in your retirement funds. You can create a futures IRA and trade that using spreads. You have less risk, so it's acceptable to use in your retirement accounts. Companies like TradeStation, I mentioned them before. For instance, if I go out to, there we go, it's my TradeStation account, or one of them. Log in, it'll take me a moment. And it's going to send me a code. Oops. Typed it in wrong, didn't I? There it goes. And this is the TradeStation Futures Plus platform. It's the only way you can trade futures spreads in TradeStation. You can't do it on the normal platform. You got to use this, which is web-based. And let me go to Future Spread Trader for now. I actually had that set up to trade options on futures, believe it or not, because you can do that too with that program. And this is showing me crude oil right now. I don't know why it's going all the way back to 2021, 2019. There we go. Now we're up to normal times. But this is showing me a spread where I could trade December crude oil versus maybe January crude oil or versus February crude oil. And it's giving me bids and offer quotes right there. This is, I think that's right. Now it's not populated yet. There's the spread. There we go. So this is a spread where I could trade December versus June 2026 crude oil. And I can create charts for this as well. As a matter of fact, let me go ahead and open up my workspace. Future spreads. There we go. Discard changes. And I'll open that up in a moment. Now, one of the things I want to mention when we're trading these spreads, we don't actually chart it like this, putting one above the other and trying to look at the white space between the two. You can see this is a March versus July crude oil chart from 2024. The way we chart spreads is a little bit different. You simply chart the white space. So what I mean by that is, if I go back to my platform here, let's say I want to do crude oil or corn versus corn, right? Remember, we were looking at CZ or ZCZ 2025. And let me get rid of the other one. It's taking a moment to load up because I got so many things going on here. I'm going to close that out for now. There we go. And get rid of this guy. There we go. So here's my daily chart on corn 2025, December. And if I'm going to trade a spread, instead of putting in that second line and trying to figure out the white space between the two, what I can do now is take the corn December 2025 minus corn March 2026. And basically what this is doing, you see it says negative 14 right now. If I were to go out to the CME Group website, once again, markets, corn, and quotes. Right now, the December contract is trading at about $4.23 in 6/8 or 3/4. The March contract is trading at $4.38. So basically, my chart is taking that 423.75 minus 438, the price of the March contract, and there's negative 14.25. So when we look at the chart, what is my chart saying? Negative 14 2/8 or 14.25. That's all it is. It's showing you the price difference between one minus the other. That's what I put in this order or the symbol. Instead of one symbol, I simply put in, okay, take one symbol, subtract the other symbol from it, and give me what's left. Why would I do that? Because now I can look at this and see, are we in a strong trend in a certain direction? Or perhaps we are overbought. And when we're overbought, we might come back down into the average. What does that mean? Well, I could see that this is going to go down most likely back to that mid band, because that's what we usually do. We overextend, come back, overextend, come back, overextend, snap back. That's why it's an average. I could sell the December contract and buy the March contract. And if prices do come back, I won't make a huge amount, but in this case, it's roughly 2 points. Well, every point in corn is worth $50. So that'd be $100 profit. How much would that cost me? Well, let's find out. Remember, the reason why I do spreads that over doing directional trades, number one, higher probability. Number two, it's cheaper. Okay, I showed you the margin on the NASDAQ was $33,000. If you did the spread on the NASDAQ, it was only $300, $350, something like that. So corn, let's take a look. December 2025. We're going to short the December and buy the March. If I was going to make $100, it would only need a margin of $300 to make $100. That's a 33% rate of return in probably a day or two. It's pretty good, isn't it? Meanwhile, if I was bearish on the front month contract, I could just simply sell that corn contract. But what happens if it goes up? What happens if it goes sideways? What happens if it doesn't go down, or it does go down, but doesn't go down very far? Well, again, then I lose. But when it comes to the spreads, even if both were to go up, but the front month didn't go up as fast as the back month and they caught up to each other, I still profit. So independently, it doesn't matter which direction the underlying security goes, I can still profit from a corn spread because the relationship between the two is not where it's normally at. Either the back month is going to rally or the front month is going to drop, or a little bit of both. Or if I'm wrong, then it doesn't. Again, you could lose money as well. The nice thing about spreads, there's only a couple types of spreads. Pretty simple. There's two main types. You have intra-market, meaning you use the same underlying security, but use different months. That's what I was just doing with corn. I was looking at March versus December corn. And I was looking, by the way, those types of spreads where it's the same underlying security, just different months, there's two different types. You have bullish spreads and bearish spreads. It all depends on what you're doing with the front month. Again, that's the one with the most volume and usually the one that expires next, but not always. So if you are buying the front month, that front or near month, If you're buying that one, you're expecting them mostly to go to the upside and that front month to go up faster. That's a bull spread. If you think the back month is going to go up, that's what I was just doing. Remember, I was just looking at this and saying, wait a minute, right now, this is too overbought. See, it's already coming back down. So I was going to sell the December contract and buy the March contract. Well, December is the front month right now. That's the one that's expiring next. That's a bear spread because I'm bearish on the front month. What kind of spread could you use on toss? Intra markets work very well on toss. Some intermarkets. The problem is they may not recognize it as a spread. There are some that are recognized by both the exchanges and the brokerages, and they give you the margin discount, which is really the biggest advantage of doing spread trading. Some are not recognized, and therefore you may not want to do those because there's not really an advantage. So it just depends. I haven't traded live on Toss for spreads for a while, so I'm not sure which ones they actually recognize. But when you go into Toss, for instance, let me see, bring that up. You'll see something called pairs trading, and pairs trading technically is spread trading. Using when you say pairs, usually referring to stocks. You can actually do this with stocks, ExxonMobil and Chevron, right? Those are related companies, or what was it? Think of the chip makers, AMD and Intel. Those are related companies. You can actually trade spreads on those as well. And you can chart them just the same way I was doing here on my trading view in Thinkorswim. But there's also a tool, like I said, called pairs trading where you can actually trade the spreads. And let's see if I get that open there. Loading up. So under trade, there it is, pairs trader. And I've actually got it loaded up right now. NASDAQ versus Russell. But let's say we wanted corn, the same one. I just do ZCZ25 versus ZCH26. What? Oh, I forgot the forward slash. There it is. And appearance. You can use any kind of chart you want. Candle chart doesn't look as good on some of these spreads, so that's why I had it changed. But yes, you can trade these. Line. There we go. A little bit better. There's my spread. Same corn spread that I was just looking at, and I can apply the indicators to it as well. If I go into, was a Bollinger Band that I had there, and you can see the Bollinger Band, we're actually above the upper band. I'm not sure what this line is. Open interest and volume. Get rid of that for now. Come on. There we are. And pair correlation, remove. Anyway, I can go ahead and trade that spread same way right there. You see negative 14 and a quarter. If I think I want to sell it, I just do sell pair, and I'm going to be selling December, buying the March, and create my orders that way too. And you can also put in stops and all that good stuff as well. Generally, the intra-market spreads will work the best. You notice if I do the sell pair there, to show me buying power effect, only $1,000. So it's not charging me the overnight margin that we would normally get for each individual leg because it's recognizing it as a spread. Meanwhile, if I just did, let's go to charts. ZCZ25 right here. If I were just to sell corn, confirm and send, notice it's 1,073 for one contract. When I was doing the spread, that was actually the same margin for two contracts. So it may not be the exact same reduced margin that I might get at other brokerages, but it is possible to trade that still. So again, you just got to check with the brokerage. Now, where they have a little bit of a disadvantage on that is sometimes you cannot do intermarket spreads. Intermarket spreads are different securities. They have to be related, and you could use the same or sometimes different months. It just depends. So I could actually trade, let's say I want to look at, well, actually, I have a list here. Go back to my September. Do I have an intermarket? Yeah, there's one. This is gold versus silver. And obviously, it's been moving around a little bit. So I don't think this is an open position. It was one that we were watching. But you can see it's simply trading gold versus silver. Now, there's another thing that has to happen when it comes to intermarket spreads. The tick values are not the same. If we're trading the same underlying security right here, this is corn versus corn, December versus March. You're trading the same underlying security, so everything's the same. The tick value, the point value, it's all the same. But when you go to intermarket spreads like this one, gold versus silver, what you'll notice is I did something a little different. The point value for corn, or for gold is $100 a point. So I multiplied that. Notice it says GCZ 2025 times 100, and then silver is multiplied by 5,000, which is a point value. The reason why I did that is what we are looking at here is something called notional value. You have market value, and that's on the chart. Yeah, right now, the market value, actually, I should do an individual security for this rather than spread, just to show you. Make sure I'm on the right one. Yes. So as an example, NASDAQ 2025. Okay. Right now, the market value of the NASDAQ contract is 24,907. That's the market value. That's what's showing. Let me get rid of the Bollinger Bands for now. That way you can see price. There we go. So again, 24,895. That's the market value. But the actual value of that underlying contract is the notional value. What is it actually worth? How much stock are you trading? So market value should be market. Notional value is the actual value of the security. And it's basically the market value times the point value. That's all it is. So what is the NASDAQ contract actually worth? Well, every point on the NASDAQ is $20. So you take that 24,895 times 20, and you're actually trading almost $500,000 worth of security, of stock, basically. That's what you're actually trading. So again, in this case, we had 24,895 times $20 per point, and it was what, 497,900. That's the notional value for the NASDAQ contract. Wait, where did that go? There it is. Now, when you do intermarket spreads and intermarket spread charting, you actually want to do it with the notional values. So you'll notice when I did gold versus silver, I didn't just do gold versus silver. I said gold times 100, silver times 5,000. Or in the case of this one, this is Mexican peso versus Swiss franc. We'll take a look at the chart itself. It's actually Mexican peso December 2025 times 500,000 minus Swiss franc times $125,000. You must use notional value versus notional value. And it gets a little bit more intricate too, because there's another thing. Let's say, for instance, I go to, here we go, my quotes. Let's go to margins. And these are the margins for individual securities. If you want to buy corn or sell corn. Intramarket spreads, they have those listed here. So if you want to trade December versus March, or December versus April, or January, because it starts in between these two periods, anything between those two periods, either December, January, or February against March or April, there's your maintenance margin. Now, maintenance margin is slightly different than the initial margin you need. To know exactly how much you would need, you simply take that number and multiply it by 1.1. So if I wanted to trade the December versus March corn futures, 275 times 1.1, it's actually $302.50 margin I would need. That's what that other calculator would give me as well. Now, intermarket spreads, now you'll notice something a little different here. Let's focus on corn versus soybeans, this top one right here. Oops, not the very top, but this one. Okay. Soybean futures versus corn. They do have the same point value, $50 per point, but their volatility is different. The way they move is different. So what we have to do, remember, we're trying to remove directional risk. We don't care if the markets go up or down. We only care about the way they go against each other. So we may need to buy more of one contract or sell more of another. And you can see we have what is called delta right here. And the ratio, it says, for every one soybean contract, we must trade two corn contracts. So this is where it gets a little more intricate. And that's why it's nice to have a mentor that can work with you and show you these types of positions. Again, if I go back to my trade ideas from last month, here's corn versus soybeans. Notice I did two corn versus one soybean. We took into account to make sure we were delta neutral. Otherwise, you're going to be skewed towards bullish or bearish, and you may not want to be. We're trying to trade nothing more than the relationship between two related securities, and we want the exterior influences to be taken away so it's much safer for us. So this becomes a much more stable way of trading using less capital and still getting good rates of return. That's what I love about future spreads. You can lose money, but the market makes it a little bit more difficult because you get more probabilities for success. Let me see. I've got an example of that somewhere here. Here we go. Let me find that one. Show you this. If I can. Come on, get to it. Here we go. So why would you want to trade future spreads over directional trading? It takes a little more time to figure out what you're doing and learn it, but the reward is great. If you're a directional trader, again, if you want to go long on a security because you think it's going to go up, you buy it. Problem is, you only profit if it goes up. If it goes sideways or if it goes down, you get stopped out and you lose. In a spread trade, if you're doing a bull spread, you could profit when both futures go to the upside, but that one you bought actually goes up faster. If they go sideways, you could still profit as long as the spread widens because it doesn't matter the overall direction if you're delta neutral. And you could even profit if prices were to go to the downside. So you have a much higher probability of success, three different ways of profiting versus only one when you're doing directional trading. Makes a lot of sense, doesn't it? Another thing is, this is not something that's just done by a few people. It's, very, very niche, very specialized. No, not necessarily. When we look at the markets, we want to do, let me see, cftc.gov. I won't have a report. The recent ones looks back on the 3rd December. Basically, what happens is everybody who trades a certain amount of futures has to report their positions to the government every single day. Do we want to be kind of emulating and following what the most successful traders are doing? The most successful person in a particular endeavor, that's I see kids that want to emulate their heroes, Cristiano Ronaldo, Lionel Messi, Dembele, many others. I can keep going on. Baseball, football, it's all the same. Or even in life, we want to find somebody that's successful at whatever we're trying to do and emulate that and copy that. Well, taking a look at some of these reports here, I'll go to the CME report here for futures, and let's see where we have a lot of different futures here. Let's find a popular one. Lean hogs. I mean, that's okay. We can do that. So right here, lean hogs, commodities. This is the report from September 23rd. And you could see we are the non-reportables because we don't trade enough to reach that threshold where you have to report to the exchange. Anyway, we have what are called non-commercials. Those are the big trading institutions. The Morgan Stanleys, the Goldman Sachs, JP Morgans, all those. Notice how much they're trading. Right now, they are long 188,000 contracts. They're short 91,000 contracts. But look at this next column, spreading. Even though it's not the majority, that's a big percentage. Looks like it's 19.9% of all the trading that's being done by the non-commercials or the big entities. That's a pretty big chunk. That's 1/5 of all their trading is being done at spread trades. Live cattle right here, 15.2%. Lumber, that's kind of low. It's only 2%. Feeder cattle, 22.1% of all the trading in feeder cattle is being done as spread. We take a look at not so much on the currencies, but even Bitcoin. I know there's a lot of spreading on Bitcoin as well. Euro, Brazilian real, where is it here? Bitcoin, there we go. 8.6% of all the trading for the professionals in Bitcoin is spread trading. And I can even look at, let me see here, Control F. Let's try S&P. There we go. E-mini S&P 500 right there. Well, there's not as much spreading going on there. It's only 1.6%. But it's still being done. There are 31,000 contracts that are being used as spread trades. So it is something that the professionals are doing on a regular basis, and especially managed money. When you break it down, there's a lot of it in managed money that is being done as spread trading. And the reason why is, again, you got high probabilities for success. It's a way of making steady income or building wealth in your trading accounts or your retirement accounts. And it's relatively simple. You just have to know what you're looking at. So again, I put out these videos, like I said, every Sunday. Well, I put them out on Saturday typically. I'm actually working on the new one for today. And I post these ideas. And additionally, what I have as well is an SMS opt-in where what happens is if the trades come into play where they're ready to go into entry or we need to make an adjustment to them, you can see that there are messages being sent out right there. So, when the videos are available, I send out a message right here. We hit a stop loss and had to exit a position. This one, this is lean hogs. We were trading the August versus February of 2026. And that long hit the upper band. We took our partial profits and moved our stop loss. Or this one was canceled because the seasonal window closed. That's a different way of trading these. When it comes to trading the spreads, we can use our technical analysis, but basically what I usually do is put out a video, as I mentioned. Let me see, open. Let's pick a random one here from September. And this is the way the video looks. And you also get a PDF of this as well. So I bring out the trade ideas, I list them, and then I explain them step by step. This was a seasonal trade idea that typically from September 28th to November 17th, you can see there's a pattern in price, usually shorting September 28th Getting out November 17th, it had a 93% win rate over the last 15 years. And the average profit, does it say? It's 93% win rate. Oh, the average profit is $1,366, but there's drawdowns. So that's why I don't just blindly take the seasonal moves. I actually go in and analyze them technically to figure out when are the best entries and exits, or where should we be getting into these and how should we trade them. And we could take a look. I don't know if that was still available. I think I already exited that one. Yeah, it's not showing anymore, but let's see, that was GFX LEM. Oops, I didn't mean to add it there, but that's okay. Take it off. And this was a trade idea, as I mentioned. What day was that supposed to be? Entry on September 28th. Should have been right here. Exiting, well, November. And you can see this one did not work out because it was supposed to be a sell. Well, we're not going to enter if things aren't correct. And in the trade idea itself, the next page, where'd you go? So I put out the chart, showed the average profit, when to enter, would have been Monday the 29th, or the middle daily Bollinger Band, where to place a stop loss. This one did not have a great opportunity because you can see the reward was much less than the drawdown. And that's something I address as well and try to adjust. However, volatility has been much higher lately, so the rewards have been much higher. And you don't have to take a trade if it's got too much volatility, if it's um, too large of risk. Again, every position right here, you can see we identify how much margin we're going to have to use. Some of them are larger than others. A lot of the currencies are over 4,000, but we get some as low as $300. And this one's an open position right now. Corn, December versus March. It was a long that we took. And we even know how much are we willing to risk for that position before we enter. We know everything about it, where we're getting in, target one, target two, how we're going to manage this. And as I've mentioned before, I showed you, looking at the tracking sheet, they have high probabilities. Works out pretty well. Again, not everyone's a winner, but that's a different way of trading the markets and getting higher probabilities. So I've got to get going here. I'm pretty much near the end of my time. Are there any questions on what I just talked about as far as spread trading, what it is? Obviously, if you're interested in learning more about that, you can click the link and go to that class. Join me with the Wealth Builders HQ, the Wealth with Spreads. If you do the quarterly subscription, you can actually try it out for free. There's a 2-week free trial. You click on that link that Andrew put out there, and basically you see quarterly plan. You basically get, and you click on that, a 2-week free trial. If you do the monthly, it's just month to month. And it shows right now, zero due right now. You do not have to worry about a coupon code. The price is locked in, $6.95 for every quarter, every 3 months. And like I said, you get a 2-week free trial where we don't even charge your card until after the free 2 weeks are up. So you can try everything out if you want, see if it's something that you're interested in, learn about the futures and see. I think it's a great program, and I'm going to keep trading this kind of futures contracts because, again, high probability and steady wealth building and steady income. It's available by doing it right. So I want to thank everybody for taking a little bit of time on this Friday. And that's all I've got for you guys for now, unless there's any questions. Nothing. All right. Well, thank you for being here. Appreciate it. And if you do have any questions, you can also email support@wealthbuildershq.com. Until next time, everyone, trade safe, trade well, and take care. Thank you.